Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He is not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. We're in the middle of the COVID recession, which will have both short and long-term effects on real estate values and housing markets. There are two major issues in that regard. Most immediately, a drawn-out recession could put many homeowners and potential homeowners in difficult financial circumstances that lead to forced home sales and a drop in home values. A short recession would minimize that possibility. The other, more enduring effect is a continuing shift to more renting as fewer people can afford to buy a home. The recession will almost certainly eliminate many jobs permanently as businesses streamline their operations and automate more of their functions. This process has been going on for a long time anyway, but will now kick into high gear. On top of that, the COVID pandemic has been financially devastating for colleges, hospitals, and local governments, which will be forced to operate on reduced budgets for many years. Let's see what the recession is looking like so far. Here we see two major ways to track the recession. The blue bars show consumer spending as the change from the same month of the last year, adjusted for inflation. The red line shows the change in jobs. To my surprise, the retail sales data for June, which just came out today, show consumer spending has snapped back quickly from the 20% plunge in April. That's partly because of the continuing shift to online sales. If you take out spending on cars and food, they now account for a quarter of all sales. At this rate, the recession will be all but over in a few months. But we need to wait to see how retail sales fare if there is not continuing financial support for people who are unemployed. That's the bad part of this chart. Despite a rebound from the 13% loss of jobs in April, there are still 9% fewer jobs than a year ago. So let's look more closely at the job situation. This chart shows the increase or decrease in total jobs in the national economy compared to the same month of the previous year. In the last recession, in 2008, the loss of jobs peaked out at 5%, much less than the current 9%, but it recovered only slowly over the next 2 years. That's our worry this time, that we'll see a quick recovery from the worst job losses as businesses reopen, but then a much more drawn-out recovery for the rest. Let's look at the various sectors of the economy to see why this may be true. As you see, jobs in manufacturing already were in poor shape before the recession. The pandemic will eventually bring more of those jobs back from abroad, but you can bet US manufacturers already plan how they can use fewer workers. Retail jobs were already in tough shape because of online shopping, and we are probably seeing a permanent shrinking of brick and mortar stores. Business services has been one of the engines of the economy and is probably the best barometer for what we can expect for the total economy. So far, recovery has been slow. Healthcare jobs should recover fairly quickly as regular healthcare from doctors and dentists resumes. But there will be lingering effects as people avoid places where other people could be sick, and especially as hospitals finally cope with the financial effects of the pandemic and cut jobs. Finance, one of the most computerized industries, has been little affected by the current situation. This is important for real estate because people with jobs in finance are homeowners. At restaurants, we see the worst of the recession. Note that the scale on this chart is 3 times bigger than on the other charts. There's been a good recovery since the bottom in April, as restaurants have been able to open in many states. But the pandemic could close them again, and it's very likely that fewer people will visit restaurants for years to come. Here's the most worrisome development. Job losses in government are getting not better, but worse. Local governments have lost vast amounts of revenue in this recession and will have no choice but to cut back their operations. Again, this will last years. It's bad for real estate because government workers too are homeowners. And I think we'll see the effect in other industries as well in the next year. Here's another example. Even computer engineers, the very people who are providing the automation that allows companies to use fewer workers, are not immune to the pandemic. I had thought these jobs were recession-proof. To finish, I want to plug our two products that are designed for investors in rental property. The Investors Metro Analysis shows the economic situation in any of 200 metro areas and what that means for investing. How much to pay very specifically tells you the best price to pay for rental properties in local zip codes. They're even more useful in times of uncertainty, like right now. You can get more information and buy them directly at our website. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.